Welcome back to study section 7, which is financial ratios calculation 1. In study section 6, we look at financial ratios generally and look at various aspects of how financial ratios can be used. And we look at that the financial ratios can be in decimal form or percentage. Can be, and when it's in percentage, be higher than 1, and if it's in decimal form, less than 1. And it can be used to compare the financial aspect of a single company from one particular year to another year, or make comparison for two companies in the same industry. Like I made mention, you can compare the financial position of GT Bank with that of First Bank or Stanbic Bank in order to know which of these banks are actually performing very well. But in study section 7, we are going to look beyond that and see some of these financial ratios, how some of them are being calculated, and what is the purpose of such financial ratios. Because there's one thing you have to understand: financial ratios on its own is not sufficient without making a categorical statement as regards to what that financial ratio stands for. This study section particularly will introduce to how to calculate some of these ratios. The first ratio that we're going to look at is profitability ratio. Profitability ratio. This ratio is used to evaluate the company's ability to generate income as compared to its expenses and other associated with the generation of income during a particular period. This ratio represents the final result of the company. By the time you are looking at the balance sheet of a company, although the income and expenses statement will also record what income of the company and the expenses made, and the difference between the two can reflect what companies actually earn as in a particular period. But at the same time, this has to be reflected in the balance sheet also. That's why we look at 3 types of record keeping, which is by balance sheet, income statement, and also cash flow statement. But the balance sheet will actually contains the profitability aspect. We show the profit that the company made at a particular period. And these profitability ratios are in different forms. But for a company to be able to thrive or performing better than its counterparts within the same industry, its profitability ratios must be reasonable, even higher than that of the average, that of industry average. So the 3 major profitability ratios are gross profit margin, net profit margin, and earning before income tax and depreciation and amortization margin. We are going to look at these 3 types of profitability ratio and see what are their purposes and what they actually stand for. If you look at the gross margin takes into consideration the revenue of the company, and you subtract the cost of goods sold from because the revenue is the turnover, the amount of sales made by the company at a particular year. And what will happen in order to determine this gross margin, profit margin, is to subtract the cost of goods sold from the revenue, and you have to divide it by the revenue times 100. Because in order to what we normally use this gross profit margin is to look at what company has, how much company earn from the sales and its activities at a particular period of time, which may be in a month, a year, or it depends on the period that a company is taking into consideration. For example, imagine you run a company that sold 15 million naira worth of shoes last year, and the gross profit is 7,000 naira. You can see that the revenue of the company is 50,000 naira. But after taking into consideration the cost of goods, although the cost of goods, let's say taking into the cost of goods is 43,000, then the revenue made will be 7,000 naira. So what you need to do in order to determine the gross margin is to look at the gross profit made of 7 million naira divided by the cost of goods sold of 50 million times 100, and that give you 0.14%. But like I did mention in study section 6, that the company financial ratio can be in decimal form, which is 0.14, and can be in amount higher than 1, which is in percentage. So in order to determine the percentage of this, you multiply by 100, and that will give you 14%. Although on its own, if you look at the gross margin for a company like this, 14%, you cannot actually specifically say that the company is doing fine. The only thing we can see there is that for every 1 naira in shoe sales, the company is making 14 kobo. That's the purpose. You can now say that that's what the company is making. But in order to make use of this statement properly, you can look at the past profit margin of a company last year. If, for example, the gross margin for last year was 18%, that shows that the company is actually not doing fine this new year. If it is less than 14%, you can say that the company is actually improving. You can use this also to compare companies in the same industry. Like I made mention the other time, let's say we have a company that's making shoe, and that company is AB. Another company making shoe, that company is CD. If the company that is making company AB is making 14% this year, and the other company is making 15%, can now say that company AB is not doing fine as company CD, because company CD profit margin is higher than that, and can be used for any other company in another industry. So the purpose, like I made mention the other time, that for every sales made by this company in terms of 1 naira sales made, the company is earning 14 kobo in profit and spent 86 kobo to make such shoe. So the comparison can be made to look at the last year profit or the last 2 years in order to determine whether the company is doing fine or not. The other one is net profit margin. If you look at the gross profit does not take into consideration how much tax a company has paid during the period under consideration. But by the time you are taking net profit margin into consideration, you can see that you want to determine that you have to look at the profit after tax over revenue times 100. And PAT, which is called profit after tax, what you need to do is to look at how much tax have been paid by the company, and you subtract from the gross profit, and that will give you PAT, which is profit after tax. And you use that one, that one will be divided by revenue times 100. Let's say, for example, we have two companies in the same industry. Let's say company XYZ made a revenue of 100,000 naira and operating income of 30,000 naira, while a company ABC made a revenue of 225,000 naira and operating income of 80,000 naira. Both company XYZ and ABC operate in the same industry, as I've made mention. Then we have to determine which company has a higher net profit margin, because these are the things that the stakeholders would like to look at, especially the company's shareholder. They prefer a company, they like their company to make more profit, and they would like to look at that, whether their company is making more profit than other companies in the industry, or compare last year's profit with this year. And they are more interested in this net profit, because after taking tax into consideration is then you have net profit, which is the one available for company to retain or to be shared among the shareholders. Also, banks will like to look at the company, how the company is doing in terms of its net profit margin, before the bank can decide whether to lend or not. Let's look at this. If a company XYZ that made a revenue of 100,000 naira and operating income of 30,000 naira, we have 35.56%. While the other company, ABC, that have made a profit after tax of 80,000, which is operating income, and sales of 225, that's 30%. So you can now see that company ABC has a lower net profit margin. Company XYZ has a higher profit margin, and that company, insofar they are in the same industry, is performing better than the other company. Then earning before interest, tax, depreciation, and amortization is called EBITDA margin, and this normally being used to take into consideration the interest rate, the interest being paid on loan, taxes paid, depreciation that in terms of making provision for the asset being used during the period, or amortization, how much asset the company set aside for future. So this way, the moment you have to subtract all these expenses, by the time you subtract these expenses, then you will have EBITDA, which is called earning before interest, tax, depreciation, and amortization. Then we have liquidity ratios. That what we discussed the other time is profitability ratio. Liquidity ratio determines a company's ability to cover short-term obligation and cash flow, while solvency ratio are concerned with long-term ability to pay ongoing debt. We normally mix these two ratios together. They are not the same. They are quite different. Liquidity ratio only determine what is the cash position, liquidity position of the company. That if a company is carrying on a business as of today, how much cash is it the company is having available to be using for the day-to-day running aspect of a company. The other one is solvency ratio, which are concerned with the ability to pay debt as at when due. If a company is not solvent, there is tendency for such company, if care is not taken, to go into liquidation. So liquidity ratio does not mean that a company cannot pay its debt. It may show that the company's current assets may be lower than current liabilities, and the company may not be able to perform very well in terms of its day-to-day activities. The common liquidity ratios are majorly two. We have current ratio, which is being calculated by using a current asset over current liabilities. At times, people use current liabilities and divided by current asset. When you have high current ratio, that shows that a company current asset, which made of stocks, cash, bank balance, and receivable, can be used to offset the company liability, which are in form of stocks, creditors, and amount payable. So these are what the company normally use to know whether it will continue. You can, on daily basis, it has sufficient cash to be used to carry on its activity. Then when you look at the quick ratio is being calculated by looking at the cash and cash equivalent and marketable securities that are available that can be sold easily, that are very highly liquid, and account receivable, plus then you have to divide by current liabilities. So both the quick ratio and the current ratio can be used for a company to know whether it's highly liquid or not. So these two ratios is actually being used in order to determine the cash level or liquid items of the company that can be turned into cash in case the company needs funds to be paid, especially to the creditors, or to meet some other obligation. So as regards to the solvency, it relates to a company's overall ability to pay debt obligation when debt is due. Can the company pay its debt as at when due in order to continue the operation or its activities? So if a company is not solvent, it may go into liquidation, and that will actually jeopardize the activities of such company. While liquidity focuses more on current financial accounts, you have to look at the current position, how a company is being run, and a company activities are undertaken from day-to-day activities. So a company must have more total assets than total liabilities to be solvent. Take that one into consideration. A company must have more total assets than total liabilities to be solvent. Also, for liquidity position, a company must have more current assets than current liabilities to be liquid. Because if you look at the main balance sheet of a company, like I made mention before, it contains two sides. It has the assets on one side and then liabilities on the other side. Where you have the asset of the company, you have to look at a company total asset. You subtract total liability from it. That will actually give you solvency level. Then in the balance sheet also, we have two items on both sides of the balance sheet. One aspect look at the current asset, which made up of stocks, cash, balance at the bank, and receivable, and also debtors in some cases. Then the other aspect which is current liabilities, stocks, creditors, payable, and other expenses incurred which have not been paid. And then the difference between the two will actually give the liquidity position of a company. When you have more current assets than current liabilities, then such company is not that liquid. And when current asset is more than current liability, it says such company is highly liquid. It's will be able to carry on the business. So the solvency position should not be taken into consideration, should not be taken as liquidity. There are two different types of items. Solvency, for solvency to take place, a company must have its total asset must be more than total liability. Why? For a company to be highly liquid, its current asset must be more than current liability. Then we have activity ratio. Activity ratio is a type of financial metric that indicates how efficiently a company is leveraging the asset on its balance sheet to generate revenues and cash. There are some companies that make use of outside finance than its own capital, and this activity ratio determines and it will indicate whether a company is actually making use of its own asset in the balance sheet to generate rather than external fund, because the capital of the company is part of the assets of the company. But when this can be used to know whether a company is actually looking for outside balance capital than inside capital. Then we have activity ratios in terms of when you are comparing two competitive business within the same industry to determine how a particular company stocks or stacks up among its peers. You can use the activity to determine such. So it's very, very important. Advantages of activities ratio. Activity ratios help in the comparison of business in the same line of operation. 2. Problem identification can be done using the right activity ratio and necessary corrections in the functioning of the business. Then 3. Simplifies an analysis by providing the financial data in a simple format, which eventually helps in decision making. Then also, investor can rely on the information the activity ratio provides. That is, those people that are ready to invest in a particular company, they have to look at the information, how a company is relying more on outside funds than inside funds, whether the company is actually performing better than other companies in terms of the shares in the stock market. Then we have debt ratio. Debt ratio is a solvency ratio that measures a firm's total liability as a percentage of total assets, which we mentioned before. In a sense, the debt ratio shows a company ability to pay off its liability with its assets. In other words, this shows how many assets the company must sell in order to pay off all its liability. If a company asset is lower than its liability, that shows that the company will not be able to pay off its liabilities, that is, its credit. And such, majority of creditors or lenders of funds, especially banks, they normally don't take interest in such companies, because majority of these creditors or lenders of funds, they normally rely on a company asset as a last thing to actually realize their money if the company is unable to pay its loan or pay for the stocks. So for a company to be able to actually show that a company is performing very well, the debt ratio must be higher, and then that shows that it must be higher than 1. that is, more assets are available for the company to pay off its liability. Also, it simplifies analysis by providing financial data in a simple format, which eventually helps in decision making. It allows this activity ratio allow the company itself or outsider to analyze whether a company is able to perform very well and assist in making, not to determine the financial position of a company. The investors also can rely on the information that activity ratio provides is based on numbers and accurate, because in most cases, most of the investors in a particular company would like to say, is this company performing well? Can we actually rely on the results? Can we actually invest my money in such? Then this financial ratio is very, very important. Then the formula for debt ratio is total debt over total asset. The higher the debt ratio, the more leverage a company is, implying greater financial risk. At the same time, leverage is an important tool that companies use to grow, and many businesses find sustainable uses for debt. If you look at this leverage position, we all look at amount of capital that a company is having possession, that is being generated from the company, and the amount outside fund, because we look at this from internal funds and external fund. If the amount the company is borrowing outside is more than the capital, then the company is of low gearing. But if the amount of its capital is more than amount of its liability, that's in debt, then the company is of high gearing. Because they will determine the leverage of the company, and it shows the financial position of the company, whether the company is actually facing greater financial risk or not. Many lenders or financial analysts will only lend to a company that is of low gearing, because they know that they have not taken commitment from outside funds. Because the more the outside funds for a company, the higher the risk, because the company assets may not be sufficient to pay such company. Let's look, for example, let's say we look at a company, Ray Store is thinking about building an additional at the back of his existing building for storage. Let's say Ray consults with his banker about apply for a new loan. Let's say the bank asks Ray's balance sheet to be examined. Let's say it's overall, the bank describes that Ray has a total asset of 100,000 naira and total liabilities of 25,000 naira. Then when you look at the gearing ratio or debt ratio, you can see that Ray debt ratio will be calculated like this. That will be 25,000, which is liabilities over 100,000 naira. That shows that the asset of Ray can be used 4 times to pay off the liability. The external lender or fund providers will prefer to lend to Ray Store because it has more of assets than liabilities. If it's other way around, they will not like to lend because, or they may decide to lend, but they will be at risk. Many lenders or funds or provider of funds might prefer a company which has more assets than liabilities in order to determine whether to lend or not. So this an aspect of financial ratio calculation is what companies normally use to show the external or the outsider the financial position of a company. From this financial ratio, you can actually determine from outside, when you look at the ratio, whether the company is financially sound and has been performing well than its peers in the same industry. So the financial ratio on its own, without actually being used or being interpreted to determine whether a company is performing well or not, is of no use. The figure on its own is nothing unless it can be used to determine whether the company is actually performing better or not. Thank you for listening, learners.